Good day. So our topic for today is break-even analysis as per request of those who will be taking the registered cost accounting exam. So let's go for it. So our learning objectives for this one is to learn the definition of break-even analysis, to determine the cost concept included in the break-even analysis, and to know the method used to analyze break-even. So what is a break-even? Break-even refers to the point in which the total cost and the total revenue are equal. So meaning, the break-even are usually used for us to determine at what point in time the number of sales will be able to recover all our fixed costs. So meaning when we sold this number of units, we would incur neither loss or profit. Next, it is also used to determine the number of units or amount of revenue needed to cover total cost. And we know total cost is composed of variable and fixed costs. So, it is also known as the cost volume profit analysis. Why cost volume profit analysis? Because it involves the cost and the number of units so that we will be able to determine the number of units that will recover the total cost. Okay? So here's our computation. For the break-even quantity, we have fixed cost divided by sales price per unit less variable cost per unit. Or in some book, this is just what we call our contribution margin per unit. Next, so in some book, this is it. For the amount, we have fixed cost times the percentage of contribution margin. So what is, let's see, unit price, these are the amount of money charged per unit of product or services. So meaning if you buy one cell phone, how much is that one? Next, total cost is the sum of fixed and variable costs for any given level of production. Take note that fixed cost does not vary per unit, meaning these are usually also the capacity or the volume capacity of a particular place. Like for example, the warehouse, the machineries being used, it's the depreciation because these are fixed. Variable usually vary per unit that we had produced. So, total cost composed of the fixed and the variable cost. Next, fixed cost. We already defined fixed cost in our production concept, but just to refresh you, but I'll also put the link below. So, it's the cost which does not vary in the total for a given period of time and fluctuation in production or volume of activities. Other term as capacity or period cost. Take note that fixed cost, although sometimes it has a capacity. So, a maximum capacity. If you reach the maximum capacity, then probably you would need additional warehouse or additional machinery. But normally, if we were not able to touch the ideal capacity, then it would remain fixed to whatever number of unit we produced, even if it's 1 or 100. Next, variable are those costs that changes directly according within the production. Why? Because this change definitely per the number of unit produced. So, if the variable cost is 1, and then we produce 1, then the variable cost is 1. If we produce 10, then the variable cost is 10. Unlike fixed cost, if we produce 1 and the fixed cost is 100, then even it's 1, we still incur 100. When it's 10, we still incurred 100. When we produce 100, then we still incur 100 as long as it is within the capacity. Break even now are when the total cost of the product or total cost and the revenue meet. When they meet together, then that's the time we know that this is break-even point per hour chart. Okay? Next, we have now problem. So, sample problem. Example that reach the accountant in charge of KKR Incorporated, which sells biodegradable bottles. She determined that the fixed cost consists of property tax, a lease, and executive salaries, which add up to 100,000. The variable cost associated with producing one bottle is 2 per unit. The bottle is sold at the premium price of 12. She was tasked to determine the break-even point per bottle. So, we know that the computation is fixed cost less sales price per unit and then less variable cost unit. So, how much? We have 100,000 fixed costs and then our selling price is 12 less the variable cost of 2. then therefore our break-even quantity is 10,000. So let's try if it's really. So let's see. If you would check, 10,000 times 12, that's still 120. And then 10,000 times 2, that's 2,000. So when we deduct, it's still 100,000. Or if you don't want to memorize, you could just simply know that break-even has zero profit. So fixed cost should always equal contribution margin. So 100,000, 100,000, and 100,000 divided by 10, that would still be 10,000. So we just do the 10,000 times 12, that's 120. 10,000 times 2, that's 20, that's still 100,000. And then presto, we don't have to memorize our computation. So let's assume that KKR wanted to earn 30,000 and instructed the accountant to compute for the number of units to be sold. That's another case. And then what if they wanted to earn 30,000 net of tax? Tax rate is 30,000. And we also need to compute for the units sold. So let's try. So we have 30,000. We started the profit 30,000 because that's the profit that we want. And then we know that fixed cost was 100,000. So 30,000 plus 100,000, that would be 130,000 contribution margin. 130,000 divided 10, that will now give us 13,000. So we check 13,000 times 12, 156,000. 13,000 times 2, that's 26,000. When we deduct 156,000 by 26,000, that still be 130. And 130 less 100 would give us a profit of 30,000. Okay? For the other one, take note that this time we want it 30,000 net profit after tax. So 30,000. We know that this is only 70% because tax rate is 30,000. So we need to divide 30,000 by 70, divide it by 70. That will give us 42,857.14. So, okay, so we add it back to our 100,000 fixed cost so that we know that the contribution margin for the sale is 142,857.14. When we divide it by 10, this will give us roughly an average number of unit of 14,285. You could round it off, the nearest percentage. So you could also, if in the event, because it's unit, it could be 14,286. Then we multiply it by 12, that will give us 171,428.57. When we multiply it by 2, that's 28,571.43. So our total contribution margin would now be 142,857.14 less 100,000 fixed cost. We'll now have a profit of 42,857.14 times 30 so that we would be able to get the tax. And that would result to 12,857.14. So you have now the net profit of 30,000, which is what the entity needs. So if you like this video, please help me reach out more people by hitting the subscribe and the like button below. God bless you and keep safe. Bye!